Would you lend Google money for 100 years? Not 10, not 30, 100 years. The main buyers of that 100-year sterling bond, UK pension funds and insurance companies.
Biggest owners of the UK equity market say goodbye, basically exit it almost lock, stock and barrel. Let's look slightly on the optimistic side. If they ever started to buy the UK equity market because they recognised it was fundamentally way, way too cheap, my God, just think of the transformation that might follow that.
Google's parent company Alphabet just raised around $32 billion in debt in under 24 hours, the first century bond from a tech company since Motorola in 1997. British institutional capital would rather fund Google's century-long ambitions than own British companies.
Yes, it's a little ironic. I mean, given their mandate, I can understand why some of those institutions might be interested. What still troubles me, and has troubled me really for the last 2 decades, frankly, is that UK pension assets are very happy to invest in overseas companies, but seem not to have any appetite whatsoever for the UK equity market, which is perplexing and troubling, and has been so for many years, and I find it really hard to explain. Nobody has really offered a proper explanation to me for this situation, which I think is approaching an affront to the UK taxpayer.
There's one more thing that broke this week that I think really sets the scene, which is the LSE itself is now an activist investor target. So in the same week, British institutions are lending Google money for 100 years to build the AI revolution. And the LSE Group, the London Stock Exchange itself, is being targeted by an American activist because its stock has collapsed and it barely functions as a stock exchange anymore. Neil, if you wanted 2 data points to describe the state of the UK capital markets in 2026, I don't think you could do much better than that.
Look, yes, they are symptomatic of this neglect, frankly, and the lack of vibrancy that has enveloped the UK capital market, equity capital market. And it is troubling. And I think what has also perplexed me for many years is that politicians have never really, the Treasury, Chancellors of the Exchequer, they can hardly be bothered about this. It's a vestigial sort of, it's a sort of shadow of what it used to be when I was at the early stage of my career. And what is worrying is that further neglect might render it to be broadly irrelevant. And in some respects, it already is. Now, everybody knows that I've been a bull of UK equities more recently, and I think those arguments still stand. But the 2 decades of neglect and ill thought through regulatory changes have left the UK market in Division 4.
The question for me is, how did we get here? And I think what most people don't realize is that this wasn't an accident. It wasn't inevitable, and it was done to us by our own regulators. 3 things over about 25 years systematically broke the UK equity market. And before we get into those, a quick note for listeners, we're about to go through the history of how this happened. Because if you really want to understand why the UK market is where it is, you need to know this. It's not complicated, but it is quite detailed. So if you'd rather skip ahead to, so what do I do about it? And that section, you can use the chapter markers along the bottom to jump to that point. But if you want the full picture, please stick with us. It will change how you think about your pension and your investments. Neil, let's start at the beginning. Pension rules. For listeners who don't know, UK pension funds used to be the single biggest owners of the UK stock market. They were patient, long-term capital, and they held about 60 to 70% of their portfolios in equities. And that was the norm for decades. In the early 2000s, there was an accounting standard called FRS 17 that changed how pension deficits appeared on the company's balance sheet. Neil, please help us walk through what actually changed and why it mattered so much.
Yes. So this was a sort of delayed reaction to really, I suppose, what happened with the Maxwell pension scandal. What regulators decided they needed to do was to bring pension assets and liabilities onto corporate balance sheets to make them more visible. And making them more visible, ensure that they were better regulated, that corporate executives couldn't make off with pension pots, etc. and to better reflect the true nature of the assets and liabilities of quoted companies. It was, in my view, implemented in the UK with a sort of zeal that doesn't really sort of reflect what happened in other parts of the world. I don't really know what explains this, frankly, but it's certainly the case that all developed economies around the world have really had to have had to adhere to this international accounting standard, but they've implemented it in different ways. As you say, pension funds started with 60 to 70% of their assets in UK equities. And that percentage now, it barely registers. I think it's about 1.5% of these are defined benefit pension schemes, by the way. What used to be the most typical pension structure was a defined benefit pension scheme. Now, 1.5% of those assets are in UK equities from 60 to 70 at the start of the process. And remember, going from 60 to 70 to 1.5 represents a hell of a lot of selling. And that's really what you've seen over the last 2 decades. You've seen the biggest owners of the UK equity market say goodbye, basically exit it almost lock, stock and barrel. This has been an incredibly damaging thing, I think, for the beneficiaries of defined benefit pension schemes. I think it's been very damaging to them. But equally, it's also been very damaging to the UK equity market. And it's one of the key reasons why the UK equity market has struggled to compete, if you like, internationally, and why it's underperformed so badly its nearest peers over that period of time.
The scale of what happened is staggering. I mean, you mentioned pension funds owned about 32% of the UK equity market in 1992. Today, as you say, about 1.5%. We're talking about £1.5 trillion pool of domestic, patient, long-term capital that essentially just walked away from UK equities.
I'm not saying everybody decided at the same time to do exactly the same thing, but basically, this was all driven by the desire of corporate execs and boards to reduce the volatility and the influence of pension asset and liability volatility on the recorded results of companies. So progressively, they decided, right, well, let's move the assets first. Let's asset liability match. Let's move out of equities and let's buy bonds. And then bonds are much less volatile asset class. And we can buy bonds that mature along with the retiring. We know when the employees or the beneficiaries of this scheme will be retiring and drawing their pensions. We know roughly how long they'll live. We know what we'll need to provide for them. So we'll stuff all of their assets into bonds that mature in a very predictable way and that will deliver the cash that we need to meet those pension liabilities. They rushed out of equities, bought bonds to asset match the liabilities. And as a result, the biggest owners of the UK equity market sold the UK equity market pretty much wholesale.
And importantly, they weren't selling because it had performed badly. They were selling because of some desire to de-risk
This had absolutely nothing to do with the valuation of the UK equity market, the prospects of UK companies, the performance of the economy, inflation, interest rate. It had absolutely nothing to do with that. It was entirely driven by the desire of companies to neutralize this volatile risk that all of a sudden came onto balance sheets. The regulators were warned that this would happen. I remember being a part of a group of equity investors that told the authorities, this is exactly what will happen. If you do this to companies, they will respond in this way and they will end up selling their equity portfolios. Do you want that? That's a bad thing for the UK equity market. We were ignored, carried on, equities were sold. And of course, the other thing is that defined benefit pension schemes closed, so that new employees, younger employees, were, as you say, were denied the benefits of those pension schemes, and defined contribution schemes took their place. Now, defined contribution schemes are now growing in importance and becoming more significant, and they are investing in part in UK equities. But undoubtedly, the biggest owners of the UK equity market, insurance and pension funds, sold out of UK equities.
Here's something I want listeners to sit with. In the US, public sector pension funds still hold over 47% of their assets in equities. The UK forced its pension funds to abandon the asset class, while America didn't. So keep that in mind, because the US comparison is going to keep coming up.
these defined benefit pension schemes own virtually no UK equities, but they still own international equities. I think broadly between 7 and 9%, I think. But that highlights not only have they deserted the UK equity market, they carried on owning international equities. But at the same time, these defined benefit pension schemes benefit from tax breaks funded by the UK taxpayer. And that, for me, is the ultimate insult that has been inflicted on the UK equity market and the UK economy by what's happened.
Okay, so pensions have left the building, the market's already weakened, and then a second piece of regulation comes along and effectively finishes the job. MiFID II, implemented in January 2018. For listeners who haven't heard of it, Neil, can you explain what it changed and why it was so damaging?
Well, it changed many things. It was introduced by the FCA. It was part of a Europe-wide regulatory change, but it was implemented with zeal in the UK. But what it basically meant was that the institutions who paid commissions on trades to brokers who facilitated the execution of those trades. What brokers used to do is take those commissions and use them to fund research that their clients, the institutional fund managers, would consume, and those commission dollars, or commission pounds, would fund that research. The research was very valuable. It provided all sorts of insights that fund managers needed to make better investment decisions about their portfolios. Inherently, this, I think, was a perfectly sensible and rational sort of structure. MiFID II changed that. It basically said you cannot use commissions to pay for research. As a result of that, commission rates collapsed. Brokers fired all their research departments, and institutions were left basically unable to access the research they needed to understand the slings and arrows of the companies that they were investing in. Now, of course, they could have funded their own research, but that was a can you imagine? I mean, basically, instead of having one single broker with one research department providing research to, say, 100 different clients, it just was a very uneconomic way to make good for that by having 100 clients with 100 research departments. That was never going to work and never did work. But ultimately, the break, if you like, the severing of that relationship between brokers, commissions, research, and institutions didn't just break the flow of that money and information and insights. It also meant that small and mid-cap companies were really sort of left abandoned because they didn't really anymore have a series of brokers that were interested in writing research on them, because the brokers couldn't afford to employ the reasonably highly paid analysts to do that work. Basically, the companies were left. There was no information about them. There was no research written about them. They weren't followed. They weren't promoted to institutional investors. The institutional investors, by the way, were still deserting the UK equity market. And so instead of imagine a sort of vibrant market where information is flowing through the market, the institutional investors that buy shares in the companies on behalf of their beneficiaries do that based on information and insights that were provided by the research analysts. When that was all destroyed by MiFID II, suddenly the flow of information through the market ends. The consequences of that break, if you like, in the vibrancy of and the flow of information and insight and analysis meant that institutional investors were no longer really focused on mid and small caps. So the liquidity in those in some parts of the market was undermined. Portfolio investors in the UK equity market tended to migrate to the FTSE 100, and so because that's where the research still sort of was generally conducted, because the trades in larger companies were tended to be much larger and were ultimately more profitable. If a broker, if it was transacting more volume in FTSE 100 companies, of course, it was going to generate more commission income. And so the interest in the market really sort of migrated to and was focused on larger FTSE 100 companies, and the mid and small cap, which ultimately are where the companies of tomorrow come from. It has been a sort of neglected part of the UK equity market ever since.
Well, here's the thing that should make your blood boil if you're a UK investor. In the US, the market that everyone compares us unfavorably to, the market where companies raise billions in IPOs, where the AI revolution is being funded, the SEC still allows commission dollars to pay for research. They never implemented this change. The market in the US is thriving. Google can raise $32 billion in 24 hours because the US has a functioning capital market with deep research coverage, informed institutional investors, and real liquidity. British companies, meanwhile, can barely get a follow-on round done. Completely different systems. We chose to break ours. Neil, why do you think this was allowed to happen?
Well, it was a piece of EU legislation, and it was implemented with great enthusiasm by the UK regulator. The people who were worried about MiFID II were absolutely right. It has completely undermined the UK equity market, and that is now reflected in the stasis now that has now sort of fallen onto the UK equity market, where there are virtually no IPOs. Small and mid-cap companies find it incredibly hard to raise capital. The number of listed companies has collapsed. I haven't got the up-to-date data on the number of companies that have delisted, but the market is shrinking every year, and will carry on shrinking, I think, unless and until somebody important wakes up to the sort of lead weight that has been hanging around the UK equity market for the last decade or more, and realizes that it's really important for the vibrancy of the UK economy that we have a vibrant and strongly performing equity market. Almost every other developed company or developed economy I know understands that is a prerequisite. And when you travel to places like the Middle East, when you go to the UAE or Saudi Arabia or anywhere like that, anywhere where the economy is seeking to grow and expand, but in the UK we seem to have forgotten that.
And then on top of all these things, we had Brexit. Now, Neil, you've been clear on this podcast before that Brexit isn't the primary cause of the UK market's problems. And I'll leave a link to that episode in the description and in the title bar at the top right. But it didn't help. What happened?
Well, it didn't help. It didn't help because I think at the time going into the Brexit vote, it was certainly the case that that international ownership of the UK equity market had increased significantly, in part because domestic ownership had reduced for precisely the reasons I've just explained. On the day of the vote in I think it was June 2016, when the result came through, international investors, having sort of consumed this disaster scenario, decided, oh my God, I mean, the UK economy is going to hell in a handcart, we're out. And so there was a lot of international selling of the UK equity market. Now, of course, the omni-shambles that then followed, the political omni-shambles in Westminster that followed the vote in 2016, inevitably resulted in a headwind for the UK economy, and certainly was seen internationally as an embarrassing disaster. Didn't help at all. So international investors carried on selling the UK equity market. But there's a different narrative now, and this is what we'll come on to.
So that's the history. FRS 17, MiFID II, and Brexit, 3 hits over 25 years. Now let's run through the evidence of where that's left us, because, as you say, Neil, the numbers are pretty stark. At its peak in 2006, the London Stock Exchange accounted for nearly 18% of total global IPOs by value. Today, it's effectively zero. For context, Saudi Arabia's market has done more IPOs in the last 3 years than London. The London market lost 44% of its listed companies between 1997 and 2019, and that trend is accelerating. In 2023, listed companies raised just £18.8 billion in follow-on transactions. That sounds reasonable, until you compare it to the 90 billion they paid out in dividends and 57 billion in share buybacks. More money is leaving through returns to shareholders than coming in through capital raising. And there's a wave of foreign takeovers picking the market apart. Wincanton, Virgin Money, Redrow, DS Smith, Darktrace, Anglo-American, the list goes on and on and on. Neil, you've argued that a stock market essentially has got two jobs. Can you explain what those two jobs are?
The risk of the corporate sector of any economy has got to be owned by somebody. The stock market enables that ownership, that fractional ownership, to be spread across institutions and private investors. And the market facilitates trade, buying and selling of fractional ownership. So that's a really important function, which people sometimes sort of miss. But it's also equally very important as a mechanism through which capital can flow from companies that generate more than they need to invest in their businesses to companies that consume more than they generate. And typically, when you think about mature businesses, mature industries tend to generate more capital than they need to maintain their capital stock. So they generate a surplus. That surplus can be recycled through the market to companies, young technology, the new companies of the future. Those companies will need capital to grow, to scale, and the stock market provides a mechanism to recycle capital from those mature industries and companies through to the immature ones, enabling them to grow and expand and be the companies of the future. Those are the key functions of the stock market. And you can see quite obviously that second function, the first function has been in part undermined by all these disastrous things that have been inflicted on the UK market. But the second function has been completely destroyed by these changes. And now young technology companies listed in the UK, or young technology companies that are private and are thinking, well, maybe we should list in the UK, are thinking, no way. If we were listed on the UK on the UK equity market, we wouldn't be able to access capital. We get no support from brokers. Nobody would write any research on us. No institutional investors would buy our shares or support our follow-on capital raises. We're not going to list. We'll go and list in NASDAQ, for example.
And this brings us to the really big question, because this isn't just about share prices anymore. There's something happening here that goes beyond share prices and pension allocations. Of course, we're in the middle of the biggest technological revolution since the internet, probably even bigger than the internet. And the way it's being funded tells you who's going to own it in the future. So Alphabet, 185 billion in capex this year, double last year. The big tech hyperscalers will borrow over $400 billion in 2026. AI and cloud capex is going to reach $3 trillion by 2029. All of this infrastructure, the data centers, the chips, the AI models, is being built in America, funded by American capital markets, owned by American companies. But British capital is helping to fund it. Our pension funds are literally lending Google money for 100 years to build the future. The UK isn't just failing to compete in the AI revolution, it's bankrolling our competition, effectively. What does that mean for Britain in 20 years, in 50 years?
It's easy to paint a very bleak picture. The UK still has, and its research and technology is still highly regarded internationally, and certainly in America. Jensen Huang, NVIDIA's CEO, said as much a few months ago at the end of last year. And it's fair to say that the UK is investing in AI. It is building data centers. AI is being developed. We have got a vibrant technology sector in the UK. But it could be so much better if our capital market was functioning properly, in my view.
Don't we risk just becoming a customer of this technology instead of a builder of it? We consume AI instead of creating it. All the profits and all the tax revenue flows to the US, not to the UK.
Yeah, you're right. Yes. I mean, there's no chance that any UK company could rival any of the Mag 7, for example, or any of the emergent AI companies like Anthropic. That race has been run. I mean, there's no chance. But so we will be the customers of that technology here in the UK. But there are other roles that we can play that mean we are not subjugated totally by this new industrial revolution.
Well, the irony of all this, of course, is that it was our own regulatory choices that made it this way. And Neil, I know you've proposed reforms in the past that you think could change the trajectory. Can you give us a whistle-stop tour of what you would put on your reform wish list?
I would completely rewrite MiFID 2. I would get rid of this idea that commission dollars could, or commissions should not fund research. That was a ludicrous idea. It was a bad idea. It damaged the market. We should undo that particular part of the rules and regulations. We should get rid of stamp duty. We should create a national investment fund seeded by the public sector with a relatively small amount of money that would then crowd in private sector money from pension funds, particularly the defined benefit pension funds who have deserted the UK equity market. It should crowd in a proportion of their assets as a requirement, not least reflecting the fact that they continue to benefit from a UK taxpayer-funded tax benefit. It should be a sort of recompense. It should be a quid pro quo, and it would, in reality, reflect what pretty much every other developed economy around the world that I've looked at is doing. Not necessarily with the same rules and regulations, but it absolutely would encourage those funds to own their own equity market to an extent, which should and ought to reflect what's happening in those other peer economies. I would ban short selling as well for any company outside the FTSE 100. Makes absolutely no sense whatsoever. It is a destructive and damaging characteristic of the UK equity market, and I don't think it serves any purpose. There are theories that it enhances liquidity. I don't see any evidence of that. I just think it damages and undermines viable companies. So I would ban short selling of mid and small caps.
Is any government actually going to do this, do you think?
No.
Because this sort of reform talk has been going on for years, hasn't it? I mean, nothing has happened really.
Nobody seems to be alighting on the very obvious solutions to that problem, which are as clear as a pikestaff, as they say.
Okay, Neil, so here's where we want to land this for our listeners. Everything you've described so far is pretty bleak for UK PLC, but what you've been saying for a while is that this is actually creating an opportunity. And I know some listeners are going to push back on that because everyone looks at the S&P 500, sees the AI winners and thinks that it's obviously the only game in town. So let's make the case. Why should anyone be looking at the UK and UK equities right now?
Right. Well, the UK economy is the sixth biggest economy in the world. The UK equity market is still a deep and liquid and functioning developed economy equity market, populated with some very interesting companies, very interesting sectors. It still ranks as a viable destination for equity investment capital, despite everything that's been thrown in it over the last 20 years. What makes it attractive right now is that because of the travails that it's had to endure over that very long period, the valuation of the UK equity market is now bashed down to a level that has become detached from peers. So the 12 times earnings, for example, that the UK equity market is on as a prospective multiple of the market's earnings compares with about double that in the US. And there are significantly higher ratings on European markets than prevail in the UK. Italy is a cheap market of a similar sort of rating to the UK, but most other European markets trade on a significant P premium to the UK equity market. So the UK equity market is fundamentally cheap. Now, maybe some might argue, well, it should be cheap because the prospects of the economy are disastrous. Well, that's just wrong. That's just a completely false narrative. The outlook for the UK economy, despite all of the headwinds, despite disastrous mismanagement of the economy that preceded this administration, despite all of that, the fact is that the economy is coming good. This will obviously be good news for the stock market. It'll be good news for the fiscal deficit. It'll be good news for the economy more broadly, and will come as something of a surprise to economic consensus, which is still so very gloomy about the outlook for the UK economy.
And of course, those DC pension funds, they can't sell again. They've pretty much exhausted their selling.
Yeah. Yeah. I mean, the one good thing about the fact that they only own 1.5% of the UK equity market is that their selling can't now damage the UK equity market. In fact, let's look slightly on the optimistic side. If they ever started to buy the UK equity market because they recognized it was fundamentally way, way too cheap, my God, just think of the transformation that might follow that. Now, of course, I will point to the fact that the UK equity market outperformed pretty well last year. It surprised a lot of people. It performed better than the S&P 500, better than the Euro stocks. It was one of the best performing developed economy stock markets in 2025. That's the first time that's happened in a very long time. It started 2026 in a similar vein. My view is this is the beginning of the awakening of the UK equity market after a very, very prolonged period of sort of, well, the market's been comatose for a long time, and I think it's waking up now.
And there's one last point I want to talk about, which is valuation, because I think it's a number listeners should take away from this episode. And Neil, you've shown over the past 50 years that there's a relationship between the starting price to earnings ratios and the subsequent 10-year returns that holds with about 75% accuracy on both the UK and the US markets. At the moment, UK equities are trading at about 10 to 11 times their earnings. The historical average is between 13 and 14 times. Based on this relationship, what are the predicted average annual returns from UK equities over the next decade?
Well, there is nothing comes close to the predictive value of valuation. Now, I'm talking about longer term returns. I'm not talking about what happens tomorrow or next month or even next 6 months or a year. I'm talking about real returns over the next 10 years. There is nothing that is more predictive of those returns than the starting valuation. And it is the starting valuation that makes me confident that the next 10-year returns from the UK equity market are going to be attractive in real terms. And similarly, why the returns from the S&P 500 are likely to be unattractive, because it trades on 23 or 24 times earnings. So when you look at the fundamentals of the UK corporate sector, when you look at the roughly 15% return on equity that is being achieved in the UK, if you believe what I'm saying about the outlook for the economy, interest rates, inflation, you could begin to believe that the valuation basis of the UK equity market is a great place to start, if you like. Potentially low double-digit returns for a prolonged period of time from the UK equity market, and that's pretty attractive.
So low double digits, and this, of course, isn't a forecast. This is just based on the historical relationship between starting valuation and your subsequent returns. Now, for everyone who's piled into the S&P 500 at 25 plus times earnings, what does the same relationship predict for them over the next decade?
Same relationship predicts zero real return over the next 10 years, pretty much. Zero.
So, zero. So everyone crowding into that same trade, being long on US, long AI, long the S&P 500, maybe they might be right for the next year or two, but the maths of starting valuations is pretty unforgiving over that 10-year period.
This is historical precedent. It's not 100% certain by any means. And, as we know, the equity markets pursue a sort of a volatile path. But there is no better predictor of future long-term returns than the starting valuation. And history's been very clear on this.
Neil, we opened with a simple question. Would you lend Google money for 100 years? And maybe the answer might be yes. They're building the AI infrastructure that the world is going to run on. But I think the more important question is what that bond tells us about everything else. The AI revolution, the biggest economic transformation of our lifetimes, is being built and owned by America, partly with British money. Now, the optimistic view, and Neil, correct me if I'm wrong, is that all of this has created a generational valuation opportunity in UK equities. The doom loop perhaps is ending because the sellers are exhausted, the starting valuations predict strong long-term returns, and at some point, the herd will wake up and realize the most contrarian trade in the world is buying the market that everyone has given up on. If you have found this interesting, please do consider sharing it with a friend. Leave us a comment, let us know what you think, and give us a thumbs up if you liked it. Thank you so much for listening. Neil and I will see you next week. Until then, take care.
Bye.